teach down at General Assembly pretty frequently on the topic. It's one of the things I sort of live and breathe all day long with my startups, and have done it for myself from many different angles. So something I'm very passionate about. So first, a little background on me and the different hats. So Rosepaul Ventures is my family office fund. So it's a fund, but I'm the only investor in it, or my wife and I are the only investors in it. In addition to that, as they said, I am a member and a board member of New York Angels, which is a New York-based angel group, 100 individual investors who work together in funding angel stage, seed stage deals. In addition, I also have, through Rosepaul, a fund of funds vehicle. So I'm an investor in a number of VC funds. Happy to say I'm an investor in David Teton's FFVC fund. I have a lot of respect for their model and all the help they provide. So within that, I think probably the most relevant pieces of that are the New York Angels piece, and then the piece for Rosepaul Ventures. There's quite a bit of overlap there, I would say. About a third of the deals that I get involved in touch the New York Angels platform. I'm fairly active. In terms of active, what does that mean? I did about 6 net new deals last year. I'm on pace to do maybe 10 or 12 this year, and then that's plus follow-ons and other things. I tend to invest 25 to 250 in seed stage deals. Seed stage for me is valuations less than 5, so 2 to 5, that kind of range. I'll selectively follow on valuations higher than that, but I won't often get in for deals that are higher than that. What does that mean in terms of a stage of development? There's a product of some kind, right? There's some level of traction, right? And I'm evaluating founders that are there and present at the time, right? Kind of companies I invest in, well, broadly, software-based business. So what does that mean? It could mean SaaS platforms. I like B2B quite a bit. I love disruptive B2B models in old line industries. One of the companies that both David and I in is a company called MoveLine, which is disrupting the moving industry with an Uber-like platform, right? Fits right into the wheelhouse of things I really like. I'm also an investor in consumer marketplaces of various kinds. I like the marketplace model. I think I understand what makes them work. I'm also an investor in e-commerce tools of various kinds. New York Angels is on a monthly process, so they screen about 100 deals a month. To give you some idea of that, out of those, they pick 15, or we pick 15 to pitch in person. So those 15 companies show up on a Wednesday morning. They'll have a 10-minute pitch, 5-minute Q&A, 5 minutes of investor discussion. We move on to the next one. We do those back to back. We get together at the end of that meeting as a group, maybe 40 people, and look through comments and ratings that were made on the companies and decide where is there enough interest to follow on. Out of those companies, 15, maybe 1, 2, 3 will make it on to the, have enough interest to move on to discovery and due diligence. And out of those deals that get to a term sheet, we will bring them back later in the month or in the following month for a formal presentation to the entire group. So it's a finished deal at that point, to give you some idea how that works. So I'm a bit of a gateway into that, as are many of the New York Angels. If a deal looks like it fits that profile, I'll help bring it in. In terms of advice, like I said, I started out teaching an hour course down at General Assembly on fundraising and pitching and that sort of thing, and it grew to 2 hours, and it grew to 3 hours, and even longer than that. There's a lot there. It's a very nuanced subject, I think, right? People like to boil it down to really simple pieces of advice, and I would say most of the time you need to resist the temptation to think these things are simple, because they really aren't. These little bits, little sound bites, often, they may be true, but you got to understand them at a slightly different level. But the few that I would put forth in a short period of time, one, if you don't have to fundraise, you shouldn't. Avoid fundraising, right? You don't have to raise money now. If you can possibly bootstrap for a little bit longer, there's so many good benefits for doing that, so many good reasons I won't get into. Fit. Look for investors that fit your startup. I invest in things I know. Other people invest in things I know. If I've never invested in anything that looks like your startup, the chances I'm going to invest in yours is de minimis. You can look into someone's background, look into what they're doing, find things that fit, find things that overlap. They're in your business model, they're in your industry. Find as many of those things as you can. You can waste a tremendous amount of time talking to people that don't invest in your stage or in your sector or whatever it might be. And finally, relative to pitching, I think I pick up on themes that I heard in the prior discussion in our second keynote. Avoid pitching, right? Pitching is kind of awkward. You're trying to sell me something, right? Ask for advice. Engage people in a different way. Get around to pitching later. And then when you do get around to pitching, think about it like a student. Know that it has depth to it. It's something you need to learn over time. No one is good at pitching typically to begin with. It's something you can learn by practice and study. Thanks.